Hello, and welcome to our online event entitled Watch Out for Those Unexpected Events. My name is Don Williams, Managing Director at RavenPack. By way of introduction, RavenPack is hosting this webinar, and of course, as you may have guessed, our firm produces data products in the rapidly evolving area of news analytics. For those of you who may have only been recently introduced to the world of news analytics, here is a very high-level description. News analytics refers to news that is quantified for use within trading models. This involves the application of natural language processing techniques to news flows to produce a data feed that describes the news numerically. Generally, news analytics feeds are available with updates in real time, daily, or on a monthly basis. Often users aggregate the raw quantified news into daily, weekly, or monthly factors and indices for use within their models. RavenPack caters to sophisticated funds that want to make their algorithms news aware. We have a number of the world's top hedge funds and institutions as clients. Our clients pursue a variety of applications using RavenPack content, including event-based trading and the calculation of factors for alpha factor models and risk applications. The firm is differentiated from others in the marketplace due to the sophistication and quality of our products, but also by our research initiatives that are designed to generate application ideas. With that overview of news analytics and RavenPack, let me introduce our first speaker, Armando Gonzalez. Armando is RavenPack's CEO and Chief Product Strategist. He has been working on news analytics and news applications for over 10 years and is a frequent speaker at quant conferences around the world. Armando will be discussing innovations in the global macro area that RavenPack will be launching in the new year. If you like what you see from RavenPack in the equities area, wait until you see this new innovation. Finally, a quantified news solution for foreign exchange, fixed income, and commodities traders all in one. Our second speaker is Peter Hafez. Peter is RavenPack's Director of Research. Peter authors the blog www.sentimentnews.com, which you may be familiar with, and has written quite a number of papers focusing on various applications of news analytics. Peter's recent work has been around enhancing event-driven trading strategies by measuring the prevailing market environment and building models based on how markets respond to similar types of events. If you are interested in how to tune up your event-driven models, this is the session for you. Today's seminar will last about 45 minutes. We will be pleased to field a few questions at the end. You may pose a question using the GoToWebinar toolbar that should be located at the top right corner of your screen. And so we have a lot of people on today, and we'll do our level best to field as many questions as we can. And if we can't get the answer to the question online, we'll certainly respond directly to you with an answer. With that, let me turn it over to Armando Gonzalez, CEO of RavenPack.
Thanks, Don. Perhaps among other titles that I have at RavenPack, I am in charge of coming up with new and hopefully innovative solutions to the information overload and the big data problems we face in finance. Today, I'm here to talk to you about our latest endeavor. We've embarked into the so-called macro and geopolitical world, and we're looking for ways to tease out any interesting and valuable information from a sea of large number of news stories. Now, as a company, we are in the business of converting raw news into structured data products. I like to think of RavenPack as a refinery. In the same way a refinery purifies crude oil to convert it into a form that is more useful, we take raw news and turn it into analytics. The goal here is to power quantitative models and create alternative sources of alpha. So as a so-called information refinery, we can uncover interesting signals, trends, patterns, all of it systematically, things that would perhaps be impossible for humans to do. We do them with computers. When it comes to macroeconomic and geopolitical news, in our research, we're finding that there's in fact a multitude of entities that are covered by the media every day, along with a number of different both scheduled and unscheduled reports. For example, most countries out there have frequent and periodic economic announcements, such as unemployment or GDP figures. Some countries experience exceptional events like government bailouts or economic sanctions. But every day, 24 hours a day, there's someone out there, say a politician, making a policy decision or providing some guidance on their local economies, and many of these events are captured by the media, and they're making headlines every day. Now there's a lot of news, there's a lot of information, and it's, again, very interesting and a potential interesting source of alpha for all of us to tease out of. Now, why should we care about macro and geopolitical events? Well, I mean, for starters, these events can turn into so-called trading catalysts. Now, a trading catalyst can spark the biggest price changes and the greatest potential for profits or losses. This affects every asset class, from equities to foreign exchange. Their potential impact on market prices and volatility means that all investors must pay attention to these key events. And again, the market reactions that they induce. At the very least, the prospect of a significant volatility around some event, that in itself may affect the timing of a trader's entry or exit of a position and may cause a trader to reduce his or her exposure. Both the modern-day investor and trader must understand the influence of trading catalysts and identify potential trading opportunities and threats caused by this type of news and the general or changing global sentiment. Take, for example, the recent tsunami that devastated Japan this year. Stock markets around the world were rocketed by panic selling, mainly as fears of a nuclear disaster in Japan were sending shares into a free fall. The main index in Tokyo immediately dived about 6% and about 18% in the worst two-day session since the 1987 global stock market crash. Oil prices dropped sharply as traders fretted a renewed recession in Japan, many fearing that the earthquake and tsunami would hit the demand. Now, the economic cost and dislocation caused by Japan's triple hit of earthquake, tsunami, and nuclear catastrophe cast a huge gloom over global output and markets. Several of the world's biggest manufacturers, and including such names as Sony and Toyota, actually closed down. Supplies of valuable Japanese-made high-tech components dried up very fast. Even the future of new nuclear projects from Germany to the U.S. were questioned. The price of liquid natural gas, in this case an alternative source of fuel, soared. Now, whereas the global economy is robust enough to withstand natural disasters and even wars in most parts of the world, it is far less well equipped to cope with massive disruptions to the largest of economies, especially Japan, which has much of the world's technological know-how. So events like this can be big enough to blow the confidence of investors and sentiments of markets worldwide. The prevailing attitude of investors as to the anticipated price movements in a market is highly susceptible to macro and geopolitical events, and these changes in attitude are often referred to as market sentiment. Now, different investors, experts, and your average worker will have a certain attitude towards a particular market or the economy as a whole. Some experts will give guidance on interest rates and other key measures of economic health. Central bankers will confirm or deny certain views and sometimes even dare to give indications of future economic outcomes. In general, most people will have an opinion, all of which are important to trying to measure the overall market sentiment. Events in general help shape investor sentiment and ultimately market sentiment. As we know, defaults on mortgages to people with poor credit histories or large debt packaged into bonds and other more complicated instruments can lately have terrible consequences. And these types of events can wreck monumental financial institutions as we know them. The worst is that these events can also cause real dents in market sentiment and lead to major financial crises. And again, when that happens, total chaos breaks out. So again, why do we need to factor in macro and geopolitical events in our model? Well, having structured data on macro and geopolitical events going back in time means we can explore and measure the reaction of investors and build models that can help us better react to events those events that we know about or those events that may occur in the future. Now, having a database of historical events and being able to drill down to each and every instance, including the circumstances and environment of the time, can be a very powerful tool. Now, there's still much to learn about the impact of unscheduled or so-called unexpected events on the economy, but the fact that we have data and we have historical archives to do that type of analysis, again, can prove out to be a very powerful tool. Of course, there's plenty of developing trends that perhaps the final event or trading catalyst may be difficult to pick up, but if you can track those events leading up to a major trading catalyst, we can actually create an interesting way of building models and an interesting way of modeling investor behavior. Sometimes even a minor malfunction can prove to be economically disastrous, and being well informed and reacting swiftly can be imperative in today's markets. This is, again, very key to have access to information, especially events which can be not only modeled historically, but being able to aggregate the information over time and, again, trying to identify interesting trends. But in order to do that, there are many challenges. But the solution that we came up with, or the solution to capture and analyze macroeconomic and geopolitical events, can be rather simple. In the case of RavenPack's news analysis process, we've come up with the simple approach, but the technology behind it is fairly sophisticated. We start by monitoring as much of the world's breaking news as possible. As an information refinery, we built direct pipelines to the best and most reliable sources of breaking news. We build infrastructure to collect literally hundreds of thousands of unstructured news articles in real time. For example, we have a pipeline directly coming from the Associated Press, one of the most trusted sources of independent news gathering in the world. They have about 3,700 employees out there in the field, gathering news, working in more than 300 locations worldwide, and publishing news constantly, which through our pipeline we can receive as soon as it breaks. We then structure and format all these different stories, again, from all of the different sources that we gather, in order to normalize all of the content into so-called XML documents that are compatible with one another. We have special algorithms that swift through each and every story, applying tags for people, places, companies, commodities, organizations, and add thousands of other special identifiers to make sense of the text. Again, this is converting unstructured content so that computers can read it and ultimately analyze it. The system then performs analysis on each and every story for every entity mentioned in the text. It also calculates a variety of scores that determine how positive or negative the tone or potential impact may be, given any entity mentioned in the news. Now, the goal is to provide different ways to calculate sentiment. So anything from analyzing the language used by the author of the story to other more advanced methods like measuring how financial markets tend to respond to certain types of events, or again, even incorporating the different market conditions that you're operating in. The end product of this process is a unique solution that delivers macroeconomic and geopolitical information in precisely tagged, machine-readable elements, all on a low-latency feed, designed for direct integration into business and financial applications. Now, among many of the benefits, this process delivers key data most likely to influence financial markets and trading around the world, but all of it in a format that quants or quantitative analysts can use. And that's the key advantage here. RavenPack tracks and monitors information on thousands of influential business and political leaders. We have public and private organizations and companies in our database. We track countries, regions, along with all of the major stocks, currencies, and traded commodities. The aim here is to empower the business professional to make more informed decisions by incorporating as many factors as possible. Again, all of them derived from news information. The RavenPack entity database contains thousands of these names, and every name or every entity is equipped with a short name, a long name, aliases, we have common abbreviations, misspellings, valid dates, and even the relationships between entities. This permits something we call point-in-time detection of entities, where only information available at the time the information was published is considered in the analysis. Now, this helps address any form of biases, especially when data mining and generating historical archives. The proposed solution here means users can leverage comprehensive data on thousands of key political and business leaders. And we're covering heads of states, ministers, governors, senators, of course CEOs, chairmen, CFOs, major executives, among many others. Our database is equipped with all the key people that are influencing our economies, the key people that are typically in the news, and we want to know what they're saying, what they're doing. All of it is done, again, in real time. Now, RavenPack provides sentiment data on macro and economic geopolitical events across all major countries. So it's not just oriented towards the U.S. or the larger economies. The idea is to capture as many events across the entire world, wherever there is news, and ultimately in a variety of different languages. Of course, as a company, we've been tracking corporates for a long time. We currently can detect news on almost 30,000 companies worldwide. The new innovation is capturing commodities. Now, when we think of events, we also are looking for those that may affect the supply and demand of all of the major commodities. So anything that may affect agricultural commodities like corn, oats, rice, soybean, anything on lean hogs or frozen pork bellies. We're looking for news on crude oil, natural gas, heating oil, even with precious metals, tracking news or commentary views on gold or platinum or silver. Again, the idea is to pick up anything about these entities, as we call them in our system. We're also looking for news on currencies. And at this time, we can track news directly covering all major currency pairs. We can distinguish whether the news is about the U.S. and the Japanese yen or the euro-US dollar, but we can also distinguish between the underlying events about currencies. Where there's thin volume of news about the currencies themselves, there's plenty of other news about the factors that may drive currency prices. And that's the goal, to capture all of the events associated or related to these types of events or these types of entities. Also, we look to quantify any news that may drive central bankers to change their minds, to cut or hike interest rates. There's plenty of chatter and commentary and views that we can capture and elementize, produce sentiment scores on, and then deliver those to quantitative users. So again, they can incorporate these views in a quantitative sense as part of their models. Another revolutionary advancement in making global macro analysis easier is a mapping service we came up with, which allows you to map between entities and traded securities. Now, the mapping service provides basic ways to relate news analytics data on entities, like countries or organizations, to the actual trading instruments from the currency pairs to commodities futures. For example, users can relate the impact of events like oil spills or a terrorist attack on a very specific trading instrument or a specific country or globally across all major indices. So the idea is that we map entities and into a model that you can then link to a traded security. In addition, RavenPack can automatically link key events such as cabinet appointments or, let's say, an executive resignation to the correct and the actual people in the database. So we're tracking thousands of real people, well-defined, so that you can link those events to those individuals. Other events like natural disasters and terrorist attacks are being mapped to the exact geographical locations where they're taking place. Now, you can imagine these types of events, or an event in an oil-rich region might have a significant impact in crude, as opposed to one which doesn't necessarily have abundance in that resource. From an event detection perspective, there are many different types of scheduled and unscheduled events that our algos can track automatically. Everything from civil unrest to natural disasters, we can detect systematically in milliseconds specific events like cabinet resignations or news about election fraud, a blockade being applied or protests being announced. whether it's a terrorist attack like a suicide bombing or a power plant explosion, you name it. The algos, if we can define it, the algos can fetch it. In conclusion, the solution we recommend to global macro analysis is really to define a taxonomy of scheduled and unscheduled macroeconomic and geopolitical events. When you have both historical and real-time data on these events, you can then investigate the impact and relationship they have with any of the instruments that you trade or the markets that you're exposed to. Now, we think markets react differently to scheduled events than they do to unexpected events. When investors anticipate economic announcements, they obviously have time to prepare, they have time to react, or even speculate before the information is made public. However, with unexpected events, the playing field is equal, and readiness and speed become critical for the new investor. This is also for the, again, applicable for the long-term investors, as it's best to know when exactly these events begin to trigger longer-term trends. So this solution of creating or defining all the different types of events that may occur can be very useful to both your high-frequency user as well as your long-term investor. And again, nothing like this exists. The taxonomy is growing very rapidly. We have almost about 500 events well-defined about macro and geopolitics. So again, the idea is to be able to capture these events and news and be able to deliver it as a structured data feed in the same way as you currently receive market data. Thank you very much for your time. I will be answering questions at the end of the session, so feel free to submit any through your GoToWeb control panel. Again, thanks, and now over to my colleague, Peter Hoffes.
Hello, everybody. As Amanda just mentioned, my name is Peter Hoffes. Today I'm going to talk about how to potentially enhance event trading based on market response. When introducing the concept of market response, I look for ways to interpret events in a dynamic framework. More specifically, I consider how the market view on particular events may change over time, depending on sentiment environment. As part of my research, I suggest capturing such changes by looking at the most recently observed market responses to given event types. I think we can all agree that news move markets. The interesting question is, in what way? Let's look at a couple of examples. This example shows the median 60-day pre- and post-cumulative excess return following positive analyst recommendations. The market close at the day of the event is represented by a zero value. Hence, a negative pre- and post-cumulative return slope indicates a declining stock price in both periods. If we focus on the excess return to the market, as represented by the blue line, it can be observed that primarily the positive reaction is taking place intraday. In fact, we observe somewhat of a reversal in the few weeks following the event. Looking at negative analyst recommendations, a significant impact can also be observed intraday. But in this case, the continued negative drift can be observed for days and weeks after the actual event, signaling much slower sentiment decay as compared to the previous example. Being able to distinguish between event types allow us to understand the corresponding return patterns. Given the type of event, for instance whether it's scheduled or unexpected, or conveys positive or negative sentiment, can be expected to impact sentiment decay and hence the optimal investment horizon. But it doesn't tell the whole story. That is, event interpretation can change over time. For instance, should a layoff always be interpreted negatively? Probably not. The interpretation of certain event types we might expect to depend on the prevailing market sentiment environment. But how can that be measured? One idea, we could simply construct a new sentiment index at a market level. In some of my previous research, this was done based on bottom-up aggregations of company-specific events, for instance, across the constituents of the S&P 500. Alternatively, we could simply look at market response, that is, what is the stock reaction for companies that have recently gone through the same type of event? Is this likely to work? Why not? It can provide input on cause rather than effect. So for instance, why is a company announcing a layoff? Obviously to cut costs, but what is the real underlying reason? Is it simply to make the business more efficient and thereby improve the bottom line? Or is it to survive? Given the market environment, it may help us to understand what reason is the most likely scenario. So when can we expect this to work? Well, first of all, for news which isn't clearly good or bad. For example, an executive appointment. For events that have a high frequency of occurrence, not only does it provide greater event diversification, but it also allows us to extract a more local signal of market response. For instance, capturing 30 unique events may only take 1 week rather than 3 months. Secondly, it can be expected to work better over shorter investment horizons, intraday to a few days. Why? Because news tends to cluster. That is, prior to seeing an executive appointment, we might have seen already an executive resignation, or the executive getting fired, or perhaps even poor earnings. Clustering, among other things, makes it difficult to isolate the effect of individual events over longer horizons. Furthermore, having, for instance, a 1-month investment horizon, we also have to decide on what return horizon to evaluate when constructing the market response signal. If we decide that this should be based on 1 month's returns, we cannot consider any events that have taken place over the past month. This makes it very challenging getting at a local market interpretation. So how does it work? First, you need to define a universe of stocks. I consider the stocks in the top 1,000 most news liquid companies year by year. By news liquid, I mean companies that have relevant and novel news about them. Take the average stock return over the past X number of events of a given type across your entire universe. Generally, I find that the shorter windows work best. More specifically, between 10 and 30 events, which tends to capture less than a week's worth of data, at least for the most frequently occurring events. Overall, I find that amongst the most frequently occurring events, market response adds value in about 70% of cases. That is, in terms of an improved risk-return profile. Based on daily market response signals for the particular event type, a long or short position is entered following for example, the next layoff event. I've taken a very simplistic approach in my research, but perhaps it could be interesting also to consider how clearly the market views certain event types in the current environment. One way of doing that could be to look at some risk-adjusted measure instead of returns. For instance, we could consider taking the average return across the most recent 30 layoff events and dividing that by the standard deviation across those same events. With a clear interpretation, we might want to trade the signal more aggressively, while with an unclear interpretation, we might not trade the signal at all. Let's look at a few examples. This picture shows the cumulative excess return over a 10-year period for a given set of strategies. Each strategy is constructed on a daily basis as an equally weighted portfolio, including stocks for companies that have had a negative analyst recommendation. Roughly in the center, with the green line on top, you'll see a black line that represents a benchmark strategy, always taking short positions following negative analyst recommendations. For all other strategies, either a long or short position can be entered depending on the relevant market response signal. As can be observed, taking a market response approach in this case doesn't add much value beyond the benchmark. If any, this seems only to be captured by the shorter look-back windows, where the red and blue line represents 10 and 30 events respectively. The green and purple lines capture fixed 1-month and 3-month look-back windows. In contrast, considering positive analyst recommendations, we find that being able to short on those events from time to time actually improves strategy performance. Interestingly, it seems that the market finds negative analyst recommendations much more credible than positive analyst recommendations. Hence, you almost always should short negative analyst recommendations. Probably this can be explained by the fact that analysts often stick their neck out when reporting or writing a bad report on a company. Again, applying a 10 or 30 event look-back window provides the best results also for positive analyst recommendations. This picture presents the results for executive resignations. Obviously, executives can resign not only for bad reasons. In fact, it seems from the benchmark that the signal is neither a very strong positive nor a negative signal. Actually, the performance has been pretty flat over long time periods. Interestingly, shorting on executive resignations in the early 2000s would have been quite attractive, while it seemed to be more of a positive signal during the financial crisis, even though much more volatile. Had we considered how clear the market view was during this period, I believe we would have further improved the strategy. From 2003 through 2007, an executive resignation event was primarily a buying opportunity. Overall, allowing for changing event interpretation, we can get to a much more attractive return profile. Once more, the shorter look-back windows provide the best results. Finally, the now famous layoff example. If we consider the benchmark, remember it's the black line, taking a short position on layoffs on average would have been a quite attractive strategy. Still, it can be observed that most of the return was made in the early 2000s and during the financial crisis. Between 2003 and 2007, the benchmark had a slight negative drift, indicating that it would have been more profitable had we taken long positions during this period. The value add of such changing interpretation seems to be captured to a large extent by applying the market response technique. So in essence, what is market response? Well, it's simply an additional dimension when extracting the sentiment of the market and how it translates into event interpretation. Thank you very much.
Hi, this is Don Williams. We've got quite a few questions from the audience, and there's a little bit of overlap to some of the questions, so I'll pose two or three to our panelists and ask them to respond to that. The first one is for Peter. In essence, the question is, I can believe that news analytics would be interesting to high-speed traders, and you yourself talk about shorter windows for some of the analysis and market response. But I expect the signals do not persist over longer holding periods, and that news analytics may have a negative effect on portfolio turnover. What is the reality?
Yeah, I would definitely say that some types of signals may have a pretty fast decay, but definitely there are signals that are more prolonged in their impact. I showed the example of a positive analyst recommendations, which seemed to die out pretty fast, and you actually went into some kind of more of a reversal type relationship over the coming days. While if you looked at negative analyst recommendations, well, there seemed to be a much slower decay for those type of events. I would say that when you do move into the longer investment horizons, it often adds value to look at, can you say, events or the news in context. That is when you start to aggregate sentiment and capture sentiment trends on different names, simply because it is more difficult to isolate the effects of individual events due to these different clustering effects that you have. But when you do aggregate, you allow yourself to capture if certain sentiment buildups are occurring in the market, either in the positive or negative regime. In terms of turnover, portfolio turnover, of course, you know what your target is as an individual manager is obviously different. But I would say some of the when you look at it from a factor point of view, well, including sentiment factors, new sentiment factors into your model, will in some cases bring turnover up in your models. Some of the feedback is that we hear is that it kind of introduces a turnover of about 100% per year. But I would say it very much comes down to how you apply the data. Some of the things that some would say, okay, 100% is not too bad. But let's say if your target was 50%, there are other ways of doing it. So you might apply sentiment more as an overlay to some of your existing factors, such that you could enhance the momentum factor, a quality factor, a value factor by further conditioning on whether you have positive or negative sentiment on those stocks that fall into those different baskets. And if you do something like that, you will actually see more or less no impact on your portfolio turnover. In fact, some of the examples that we have seen, it actually slightly reduced turnover.
Thank you, Peter. The next question, I think, is for Armando. Can you talk about what challenges that you had to overcome to create the global macro product?
I would say the main challenge, or one of the challenges, was actually building or creating a database of entities. We couldn't find any commercially available listings of politicians around the world or listings of executives. So we actually had to create our own, do all the research, find out who maintained the position of prime minister of a certain country over what periods across over 40 countries. We had to go through the entire cabinets. We had to find out all of the different ministries that exist in one country and not another. So in fact, building a database of not only all of the politicians that we would like to track, but their positions and when they held those positions in order to make it point-in-time sensitive. So in itself, it's been roughly about a year's, 14 months, I would say, of nothing but data gathering, building such a database. And I think we perhaps maintain the only database in the world other than what governments may have. But this allows us to actually look for the very specific people or the very specific organizations that we care about in any mentions in the text. And when we did people, we then started digging into, as I said, organizations. We then incorporated places. I think we track over 1 million different geographical locations. We then started building full list of all the different currencies that are maintained worldwide, the validity dates of such, so making sure we would correctly map the pre-Euro phase into the Euro phase, and as new members have joined the European Union or Monetary Union. So that in itself was a challenge, which again was not done by computers. It was all done manually. And in addition to that, we had to build a system that could relate all these different entities and detect it in the text and deal with all the nuances and all the potential issues that you may have. Let's say you're looking for news about Gordon Brown, the minister, the prime minister. Well, most of the time, journalists mention the word Brown or say Brown announces this. But brown is a color, and that makes it very hard. So you have to figure out that's really, Gordon Brown, the prime minister, and not the color brown, or any of the other millions of browns that are out there in the world. So again, the challenge was really just being able to detect entities correctly, do the natural language processing on them. Once we overcame that challenge, we were then able to produce some sentiment analysis and a number of different analytics, and that's when it started becoming interesting.
Thank you, Armando. The next question is for Peter. You talked about windows for events. So can you explain how you compute the shorter window, 10 to 30 events, in market response?
Yeah, sure. Basically, I looked at across my universe of stocks and looked for companies that have also had, let's say, layoffs most recently. Then I looked at those and looked at how the market, how the stock price reacted for those companies that have had those layoffs. And I did some filtering such that, companies could only count once. So I would only look at the most novel events. So a layoff might have been represented more than once in the news on that company, on that, in that window, but I would only allow it to count once. And yeah, and then I simply just took the average return across those 10 events, most recent novel events across 10 different companies, or 30 events, etc. I also looked at fixed calendar windows, but mostly on the longer horizons. One of the reasons why I decided to take an event approach was that you could allow yourself to have different look-back windows in terms of calendar time, depending on what type of events it was that you were evaluating. So, for instance, for the most frequently occurring events, well, capturing 30 events you might do in one day, but for less frequent events, it may take much longer. So you allowed yourself to get, can you say, a level of confidence in your market response signal by capturing a certain number of events rather than calendar time.
Thanks, Peter. We're running out of time, but maybe we can do one more question. And this one is for Armando. Armando, you talked a little bit about the effort to produce global macro in terms of database and that kind of thing, but the question is, what technologies do you use to store the data?
For storing, I mean, in particular, we maintain a relational database in-house. So that means there's lots of tables where we store the different elements. But first, in order to do that, we actually tease out or parse the underlying documents. In many cases, because of the strategy we've opted for, where we build pipelines and we connect directly to the sources. That is, we have relationships with the AP, with Dow Jones, and other major top publishers. This content is being delivered to us in XML. Now, the XML format contains some tags, but not enough to do semantic processing. So we will tease out not only the tags that are provided by the publishers, which is just metadata in XML, but we'll parse out all of the different sentences and paragraphs and then run it through our own engines. We actually use a number of different platforms, but one of our more common languages in programming the algorithms is Common Lisp. And as part of our strategy, we tease out all the different elements in the text and then store them independently or as part of this relational view. So in this relational database, we can then access, again, all the different aspects of the story and then run different classifiers. So we always have and store that data in the way it came as well as in the way it was parsed, and then our other algorithms or our other engines can call that information from these databases in order to do some of their processing. Now, in real time, it's slightly different in that we have to do all of that on the fly. So we're going to be doing a lot of in-memory analysis, and that means that even before it makes it to the database, at least in real time, all this is being processed on the fly and then ultimately stored in the relational databases.
Thank you, Armando. And having traveled to our head office recently, I'm very aware of sort of how massive this operation is. I know we process up to 100,000 stories a day, and we maintain a database of almost 11 years of millisecond stamped news records. So it's a very extensive database, and there's quite an extensive operation behind the scenes that create all this information. So that concludes our webinar for today. I want to thank our panelists, Peter Hafez and Armando Gonzalez, for their help in putting this together, and all the other RavenPack people that have been buzzing around in the background making this webinar happen. Thank you for your questions. You will receive shortly an invitation for a webinar in November, so we intend to do these things on a regular basis. That session in November will focus on news research entitled Behavioral Trends and Market Neutrality, and develops absolute return, long-short equity strategies using news analytics and stock lending data. The session will be hosted by our friends at Data Explorers and, of course, RavenPack. We will do our level best to produce a transcript and a recorded version of this, and we'll send it out to participants, and we'll make it available on the website. Thank you for your time today, and I appreciate your interest in RavenPack and news analytics. Goodbye.